to our special segment, Quarter Se Quarter Tak, and we take stock of what one can expect from sectors as we get into the third quarter earnings season. And banking is what we are focusing on. Abhishek is standing by to tell us more. Abhishek, over to you.
Well, banking sector has seen one of the best loan growths in a while. The loan growth for the sector in Q3 FY23 has been around 17.5% YOY and about 4.2% quarter-on-quarter. So there has been business updates from few lenders which shows that private banks have witnessed strong loan growth momentum and they continue to take the market share away from the PSU counterparts. So RBI has been raising rates, so have the banks. Hence, one can expect the net interest margin of the banks to remain stable or improve on a sequential basis given the fact that banks have been raising rates on the lending side in this quarter. So asset quality will not be an issue. We may see improvement in asset quality with lower slippages and better recovery rates. So large part of the slippages may come in from the restructured book which is already known. Credit cost or provision for NPA divided by advances ratio will be lower on a sequential basis for majority of the players. Now, fee income can be the strong point this time around given the fact that loan growth has been pretty strong. We may continue to see private banks investing in their franchise, which may keep their operating expenses on the higher side. So the cost to income ratio could remain on the higher side. PSU banks may continue to see improvement in their profitability and hence improvement in the return ratios as well. Time for mid-size and small banks to report better return ratios than their larger peers in terms of improvement this time around. Hence, we may see a record quarter for the banking sector in terms of loan growth, net interest margin, low credit cost and low NPAs. Some of the estimates that we have from Kotak Securities is that they expect SBI's NII growth to be around 20% YOY and about 4.5% quarter-on-quarter, while they expect net profit for SBI to grow at 55.5% YOY and decline a little more than 1% sequentially. For SDFC Bank, Kotak Securities estimates the NII growth of 20.5% YOY and about 5.5% sequentially. On net profit, they expect it to grow more than 18% YOY and a little more than 15% sequentially. For ICICI Bank, Kotak Securities estimate NII to be up 24% YOY and close to 3% sequentially, while profit growth is expected more than 32% YOY and around 8.5% sequentially. For Axis Bank, Kotak Securities estimates NII growth of 24% YOY and close to 4% sequentially, while they are expecting profit growth of more than 46% YOY and a decline of little under 1% quarter-on-quarter. Back to you.
All right, Abhishek, thanks very much for that. Santanu Chakrabarti is India Analyst, BFSI at BNP Paribas, is joining us now. Santanu, good to have you with us here. You heard Abhishek lay out the expectations. At a very broad level to begin with, do you expect earnings upgrades from here? BFSI was the only space in the second quarter which met expectations and in some cases exceeded expectations. What is your view for the third quarter?
Good morning. So, some of the points that Abhishek made clearly resonate with me as well. We remain fairly confident about the balance sheet situation. So the low credit cost part of the equation, etc., it should continue as is. Now, coming to credit growth, which has been the defining factor of banking sector performance, especially private banks, we don't expect it to slow down either in this quarter or, going forward. The only place where we see that the next quarter in itself might mark the peak is in terms of margins, because most of the pricing benefits that we see on the loan side are about to come in either in this quarter or at most in the next quarter. And from that point onwards, both in terms of changes in liability structure, that is a tight CASA market and maybe increased flow of fixed deposits, should ensure that cost of funds go up a little bit and margins could moderate a little bit next year out. That's our broad view on the sector and, how we are looking at it.
All right, so that's your broad view. Wanted to understand in the private banking space itself, do you think there's more valuation headroom now? There may be sort of growth headroom, but on the valuation front, how are you looking at it?
So, Sonia, if we go back and look at private bank valuations in the context of, say, the last cycle as well, you'll realize that there is a part of valuations which is often ascribe to what the growth potential looks like. Because in private banks, high growth also means probably dilutions at a premium and therefore boost to book value through that. So from that point of view, looking at deleveraged balance sheets across corporate India and bank balance sheets which remain clearly powered to play into that opportunity, we believe that valuation headroom as the cycle takes an upturn remains there. The second part of the valuation nuance that I would like to bring in is that if you simply look at the valuation band chart of a bank, you might feel that we are at median and in some cases above median levels. But please understand that book values today mean very different thing from what book values would have meant 5 or 6 years or 7 years back, because we are looking at very clean balance sheets. So the equity with which we are working, on which we are computing the valuation, is a much more bulletproof number, if I might say so. So I think valuation headroom still remains within the private banking space. Of course, it differs by name and outlook of individual banks. But as a broad theme, I don't see any challenge to valuations of private banks, barring any large surprises on asset quality, which look very, very unlikely to me, as your analyst also pointed out.
Santanu, from a tactical, more trading kind of perspective, I'm sure you've got clients, the hedgy sorts asking you, which is the best play, around the earnings or into the earnings or post the earnings? Anything comes to mind out of the lot?
See, if we look at the, instead of going stock specific here, I'll try to outline a couple of themes which might be interesting from the next earnings season perspective. So one is that if you look at the texture of credit growth, in the beginning of the year, the only places or segments which were seeing growth for the large private banks was actually mortgages, unsecured lending. The common thread seemed to be these are all high, rather low touch, urban prime kind of businesses. As we neared the second quarter, and I think that momentum should continue into the third quarter and fourth, is that you'll see a lot of, if for the lack of a better word, high touch and NBFC adjacent kind of segments like SME, rural, agri, CVC. These segments will start to do well. So while credit growth will remain high, the relative weightage of segments might change going forward. That has certain implications for certain asset-specific plays within banking, and that's a tactical move that I think some hedge funds or other investment partnerships could look at.
Okay, we will. Sure. We'll let you go on that note. Thanks a lot for joining in. And that's Kotak Securities with their expectations of the banking sector